Thank you for joining me. I'm Juan, and today I want to revisit SENS. Is this still a buy for me? Has anything fundamentally changed? Is it more of a macro issue? I've done several videos on SENS, and it's one of the companies that I've always been bullish on. I like the company, I like their product, I like the management team. So having confidence in the management team is extremely important. A good team can make all the difference. If we look at Home Depot in 1990 had about 118 stores, and their revenue was about $2.8 billion at the time. Share was trading at $1.87. So if you would have bought back then because you had strong conviction on the company, you felt like they had a great product, you felt like it was a strong management team, today the stock trades for over $300. They have over 2,291 stores, and they bring in a revenue of over $110 billion. But what led them to the success? It was strong management, because in 2008, 2009, with the declining in the housing market, they were able to survive. And how did they survive? By quickly changing what they were doing. They immediately stopped the plans to open 50 stores. They shut down 15 stores that weren't generating as much revenue, and they reinvested in their current stores. And they made it more friendly and easier for the customer. Because of that, they were able to survive the housing market bubble. They're strong today, strong company. I don't think SENS is going to have the success that Home Depot had, but I do think that they will survive right now, the stage that they're in. A lot of their money goes to R&D. They're still in a high risk type of area. So because of those reasons, I only invest a small portion. When I talk about a stock like this, that's not a blue chip stock. That's not like investing in a mutual fund or ETF where most of your revenue, where most of your investment should be allocated towards. Not an actively managed index fund, but just any index fund or any ETF. A good index fund or a good ETF. That's where the bulk of your money should be in. But I allocate about 3 to 2% for some of these higher, riskier type plays. So SENS is one of those few stocks that I do invest in. I do have a few thousand shares, which isn't much. I bought it under $2. I'm just going to hold because I believe that they have the potential. I've created a DCF based off of what I think they have the potential of reaching. So what is a DCF? So basically a DCF is a valuation method that estimates the value of an investment using future cash flow. And it's important when you use this future cash flow, you have to bring that back to today. What is that money worth today? So let me break this down in a simple example. Let's say your friend comes to you and he says, I'm looking for $10,000. I need you to be an investor in my company. So 1 year starter, I'll pay you back in 1 year with 5%. There's a present value formula where they basically, to get present value, you take the future value, which is the 5% on top of the 10,000, which would be 10,500. And you divide it by 1 plus whatever the rate is and the time. So it's 1 year. So to be 1. So in this case, I would say, okay, look, let's do the CPI is coming in at 9%. So that's going to be the dividing factor, 1 plus 9%. So it'd be 1.09 divided by 10,500. And you get $9,596.28. So that means if I do invest it, even though I'm getting 10,500, it's going to be worth that 9,500. So I would tell them, no, I would need something like 15%. So this has been their timeline. They've had their ever since 90, which is the CGM device implanted, and it would stay there for 90 days. They got the approval in Europe back in 2016 for 180 days. And their biggest news was when they had their FDA approval here in the United States for 180 days. And the next product, which is going to be a very competitive product, 365, I feel like they have a great marketing team, but that by itself is such a strong marketing point. Having a device that you only have to change out once a year, this is the potential. This is another reason I'm bullish on this, because the market share, the potential for the CGM diabetes technology is over $14 billion and growing. It's a high growth market. It is dominated right now by Dexcom, Abbott, Medtronics. I do think Senseonics can definitely get some more market share, more than what they have now. This is why I say that they're going to capture some market share. If you even go on certain blogs, there are a lot of people that aren't happy with Dexcom, with Libre, with Medtronics. And their market share here, the people they want to grasp, 29% are new. 29% are people that are potentially interested in CGM. So that's a great market to potentially obtain, because if you market it with these guys, you have to change out the device every 2 weeks, every 14 days. I'm sure by next year, they'll probably look to increase that. But as of now, it's 14 days. The Senseonics, currently 180 days. But when they get their 365, this group right here, just knowing that they only have to insert this once and change it out once a year, that's a big factor. That's going to be big. And it's extremely accurate as these other companies. And then these other guys here, 34% of customers that are dissatisfied customer, 22% Libre, 15 Medtronics. This is also another potential. They have an alternative where they can go to another company. They can rest assured that they're going to get accuracy, and they only have to change it out once a year. That's another big positive factor for this company. So we talked about their partnership with Ascensia, which is already well known, strong company, strong leader in the BGM industry. So this is the pipeline. This is the vision. No sensor change for 1 year. They don't have to prick themselves. This is basically when you prick yourself and you compare the reading. This is how you maintain its accuracy. It'll drop down to weekly, which is excellent. And then some other things they have here in 2022, 2025, pump integration, pump aid. So this is where everybody's at right now, and this is where everybody's going. They just kind of set it and forget it. If you have an insulin pump that automatically administers medication according to your reading, it's all going to be automated, and it's something that they have to do to be competitive. Okay, so now let's look at the DCF. I'll just briefly explain. This is what I explained was DCF. You're taking their future cash flow and just kind of estimating what they're going to, what it's going to be valued at. Is it a good buy now? And when I do this, I kind of do three theses. I do this upside, base, and downside. And my upside is based on, obviously, I'm more optimistic for this one because they don't have no positive free cash flow. I just did how much market share they're going to capture as the years go down. And upside is my case. I'm optimistic. Base, if they keep the pace that where they're at now and just grow at the pace that they're currently at. And downside is the worst case scenario. As you put in all these numbers and their gross profit, the operating, all these things can be found on their income statement, balance sheets, and it gives you what the current price is and the intrinsic value according to the future cash flow. So the base model, if they just continue the way they're going now at their pace, and they've slowed down, but the CEO expected this. They came out with the 180. They said that their first half of this year, they're going to be slower, and they expect the third and fourth quarter for the sales to pick up, and more of 2023 for the sales of the 180 to start picking up. So this was expected. But if you go off of the base, they should be trading at $1.57. And that's why a lot of people short it, because this is their thesis. The downside is the worst case scenario. If the current sales drop, if they don't pick up in the third and fourth quarter like they said they would, then this company should be trading at negative 28 cents. So that's the worst case scenario. And that's why I say it's a riskier stock. It's a riskier company. Take a very small portion of your investment if you're bullish on it. And it's an amount that you should be okay losing. So the potential I have for it, I think it can be trading at $7.65. So that's not bad to me. I'd say if I have 2,000 shares and I make $6 on it, that's $12,000, which is great growth for a $4,000 investment within a couple years. And that's how I'm treating it. That's it. I don't mind having the bulk of my money in an index fund, and then the 10% I day trade with it, I swing trade with it, take a small portion and have a few risk stocks like Senseonics, RBOT, or a couple stocks that I'm bullish on that I think they're going to make it, but I'm not going to break the bank. And if the company goes down to zero and I lose my investment on it, it's not going to be something that is going to set me back. That was just it. That was my revised Senseonics DCF. It's a little bit lower than my initial one. The last one was almost $9. So thank you for watching. See you on the next video.